All right, let's dive into commercial real estate investing. We'll be looking at commercial real estate investing for dummies. I'm joined by our expert to help us break it down. Ready to jump in?
Definitely. Commercial real estate can seem a bit overwhelming, but this book really helps.
Okay, great. Now, I keep hearing about incredible returns in commercial real estate, but it's not just buying a bigger house, right?
Yeah.
What are the differences from, say, residential rentals?
Yeah, you're right. It's not just scaling up. With commercial properties, the focus shifts from appreciation to cash flow. You're essentially building a business. And leverage, using borrowed money, that's key.
Leverage sounds great for profits, but isn't it risky too? What if the market takes a dip or the property doesn't do well?
Good point. And the authors acknowledge those risks. Poor management, market downturns, even legal issues, those can all cause losses. That's why they really stress due diligence. And not just checking the information, but really digging deep to uncover any hidden problems. They even suggest going beyond the seller's financials, like asking for tax returns to see the real income history.
Makes sense. You don't want to buy a problem. So how do we even start evaluating a commercial property? Is it the same as residential, just bigger numbers?
The core ideas are similar, but the scale and the focus change. Conti and Harris highlight these three key things: net operating income, cap rate, and cash flow. NOI is simple income minus operating expenses. But cap rate, that's where it gets interesting. It's that NOI divided by the property's price. It gives you an idea of the potential return.
I see. So higher cap rate, generally that means better return. But I'm guessing a 10% cap rate on a rundown motel isn't the same as 10% on a fancy office downtown.
Right, exactly. Context is so important. Cap rates can be all over the place, depending on the type of property and where it is. Smart investors, they don't just look for the highest number, they use it to weigh the risks and compare different opportunities.
Okay, so context is key. What about cash flow? Is that just a fancy word for profit?
It's similar, but there's a nuance. Cash flow is what you have left, after all the operating expenses, and any debt payments, your mortgage. Conti and Harris really emphasize that positive cash flow is absolutely essential for successful investing in commercial real estate.
So, strong cash flow, a cap rate that matches my risk tolerance, and of course, thorough due diligence.
Okay, but how do you go beyond those basics when looking at a specific property? How do you tell a good deal from a bad one?
It all depends on the property type. For example, with apartments, you look closely at the price per unit. Are you overpaying compared to similar buildings? And then vacancy rates. If those are high, that might mean there are hidden issues. Scrutinizing the leases is also really important. Are the rents in line with the market? Any concessions that could affect your income?
So basically, don't just take the seller's word for it. Dig into those details and see if the numbers really hold up.
Exactly. And this applies to any type of commercial property. Don't just look at the surface numbers. Ask for actual income and expense statements, even tax returns, to really see how the property has been performing over time. Due diligence, due diligence, due diligence. I'm getting that message loud and clear.
You got it. Now, let's zoom out for a minute. We've talked about individual properties, but what about the real estate cycle? Does that matter for commercial investments just like it does for residential?
It seems like timing the market would be even more crucial with larger investments like these.
You're absolutely right. The book has a whole section on this. They break the cycle into these phases: expansion, peak, contraction, bottom, and then recovery. Knowing where we are in that cycle can really change your approach.
So if you buy at the peak, you're paying top dollar, which could hurt if the market cools down, right?
Yeah, exactly. But then there's also bottom fishing, buying when prices are low. It's higher risk, higher reward. But the authors say if you understand the cycle, you can spot those opportunities that other people miss.
So timing is important, but realistically, predicting those peaks and bottoms is tough. So aside from timing the market, how do you find good deals in commercial real estate? Do you just wait for listings and hope for the best?
Nope, not at all. The book is all about being proactive. Building relationships is crucial. Get to know brokers, other investors, bankers, even lawyers. They often know about deals before they become public.
It's all about who you know.
Right. But also what you know. Research is important too. Check newspapers, trade journals, online platforms like LoopNet. Stay informed.
Sounds like a lot of work. Are there ways to be even more proactive?
Absolutely. Direct marketing is another good strategy. Send letters or postcards to property owners or create a special report with helpful information. You're not just expressing interest, you're showing you're knowledgeable.
I like that. It's not just I want to buy, it's I bring value to the table. What about properties that have been listed but haven't sold? Are those always bad news or could they be hidden gems?
They see those as potential gold mines. Often they haven't sold because of the price, some unique challenge, or just bad timing. If you can figure out the WHY, you might find a solution the seller hasn't thought of, and that could lead to a win-win deal.
So we've found a property, the numbers are good, the timing is right, it fits our plan. Now comes the scary part, making an offer. Negotiating in the commercial world seems intimidating. Any tips for that?
They have this system, they call it the instant offer system, to make it less daunting. The first step is to build rapport. These deals take time. You're not just negotiating a price, you're building a relationship.
So start by building trust. Then what?
Next is transparency. They call it an upfront agreement. Both sides agree to be open and honest throughout the negotiation. No games.
That sounds refreshing. What's the third step?
This is where it gets interesting. It's called motivational discovery. You ask strategic questions to figure out the seller's real needs. Why are they selling? What's their ideal outcome? By understanding their motivation, you can craft an offer that benefits everyone.
It's not just about getting the lowest price, but finding a solution that works for both sides.
Exactly. And then, only after all that, do you move on to step 4, money talk. Now you're finally talking about the price and terms, but you're doing it with a deeper understanding of what the seller really wants.
Okay, now we're getting to the nitty-gritty. Any tips for this part beyond the obvious don't overpay?
They offer several techniques, like setting realistic expectations. Don't lowball just to lowball. Use ranges to find common ground. They even suggest a tactic called fictitious buyers.
Hold on, fictitious buyers. Is that ethical?
It's not about lying. It's about framing things strategically. You can mention other interested parties, even if there aren't any at the moment. It creates a little bit of competition.
A little psychology, not dishonesty. Got it. What's the final step in this system?
The last step is all about figuring out what's most important to the seller. They do this by asking, what if?
What if? How does that work in a negotiation?
By presenting hypothetical scenarios, you can see how flexible the seller is without making a formal offer. For example, what if we increased our earnest money? Would you be willing to shorten the closing time?
That's clever. You're getting them to reveal their priorities without committing yourself.
Exactly. Now let's say we've made it through this system. We've got an accepted offer. So we meet the seller in person, right?
Seems logical, but is a meeting always necessary? What if everything has been smooth sailing?
They're big believers in face-to-face meetings, even if the seller isn't so keen. They suggest emphasizing the benefits. Things move faster, you can potentially close sooner. You can even appeal to the broker, since a meeting could get them their commission faster.
Okay, smart tactics. And assuming we get that meeting, how do we make it count?
Be prepared. Know your goals, have your questions ready. They recommend using a combination of letters of intent, which show general interest, and formal purchase contracts for the finer details.
So we're not just chatting, we're ready to make things happen.
Exactly. And one last thing. Make sure your contracts have escape clauses.
Escape clauses, like a get-out-of-jail-free card?
Pretty much. They let you back out if certain conditions aren't met. Maybe due diligence uncovers a problem or financing falls through. It's all about protecting yourself and making sure the deal stays favorable.
That's reassuring. It takes some of the pressure off knowing you have an out if things go sideways.
That's right. The authors are all about taking calculated risks, not blindly jumping in. So we've negotiated, we've met, we've got our contract with those escape clauses. Now comes the serious stuff, due diligence. What does that look like in commercial real estate? Due diligence is where the rubber meets the road. It's about going beyond what the seller tells you and verifying everything yourself. It's your chance to find any hidden problems, assess the real value of the property, and confirm that the deal aligns with your investment goals.
It's like putting the property under a microscope, but on a much larger scale. What are some key areas that are covered during due diligence?
The most important thing is the physical inspection. We're not just talking about a little paint chip. We're assessing the roof, foundation, electrical, plumbing, anything major that could lead to big expenses.
We're bringing in professional inspectors for this part, right?
Of course. Depending on the property, you might need structural engineers, environmental consultants, pest control experts. It's a team effort to get a complete picture of the property's condition. But just as important as the physical inspection is the financial investigation.
Okay, back to the numbers. What are we looking for here?
You'll want to carefully examine the income and expense statements. But don't stop there. Ask for tax returns, bank statements, get a real understanding of how the property has been performing financially over the past few years.
So you're looking for any inconsistencies, any red flags that might not be obvious at first glance.
Exactly. This is where having an experienced real estate attorney and accountant on your team is crucial. They can analyze the financials, spot any potential problems, and make sure you're getting a fair deal.
So you're essentially confirming that the numbers are accurate and reflect the true earning potential of the property?
Precisely. And finally, there are legal inquiries during due diligence. You review title reports, leases, zoning regulations, any legal document that could affect you owning and operating the property. You want to make sure there are no lands, ownership disputes, or zoning restrictions that could derail your plans.
Wow, this due diligence process is quite extensive. I can see why it's so important for protecting your investment.
It's a lot of work, but as the authors emphasize, it's better to uncover issues before you're locked into a deal. And remember, the due diligence period is also your chance to renegotiate the terms if you find any problems.
So if the inspection finds major repairs or the financials aren't quite what we expected, we can go back to the seller and ask for a price reduction or other concessions.
Exactly, and you should never be afraid to walk away from a deal if it no longer meets your criteria.
That's good to know. It's reassuring to know you're not trapped just because you signed a contract.
You're not. Due diligence gives you the power to make informed decisions, even if it means walking away from a seemingly good deal.
Now, let's say our due diligence goes well and we're happy with the terms. It's time for the final stage.
Closing. What can we expect during the closing process for a commercial real estate transaction?
Closing in commercial real estate is a bit more complicated than in residential real estate. You're dealing with larger amounts of money, more complex documents, and often a longer time frame, but the basic principles are similar.
Okay, so where do we start?
First, we need to understand the role of escrow. Just like with residential, an escrow company is a neutral third party. They hold the money and documents and make sure all the conditions are met before the sale is final.
So it's a layer of protection for both the buyer and seller. What else is important during closing?
Title insurance is absolutely essential. It protects you against any unexpected claims or disputes about the property's ownership history.
Right, because the last thing we want is surprises after we've already bought the property. Absolutely. Before closing, you'll get a closing statement that outlines all the financial details. Purchase price, closing costs, prorated expenses, everything. Think of it like a final bill, making sure everyone is paying their fair share.
Speaking of costs, are closing costs for commercial real estate much higher than for residential transactions?
They can be, yes. Commercial deals are usually bigger, and there are often extra expenses surveys, environmental assessments, more complex legal fees. You need to factor those costs into your budget from the very beginning.
Got it. Budgeting for those costs up front is key. What happens once we've reviewed and approved the closing statement?
Then comes the fun part. You'll sign a mountain of documents, the deed, mortgage documents, and any other agreements related to the transaction.
Sounds like a lot of paperwork.
It is. But once those documents are signed and recorded, congratulations. You're officially the proud owner of a commercial property.
That's a huge accomplishment. But I'm guessing the journey doesn't end there, right?
Not quite. Now comes the ongoing work of managing and operating your investment. But before we get into that, we need to address the elephant in the room: financing. How do you actually pay for these big commercial real estate investments?
That's a great point. We've talked about evaluating properties and closing deals, but we haven't discussed how to actually get the money to buy them.
And Conti and Harris don't shy away from this crucial aspect. They start with the most traditional route: conventional loans. It's similar to getting a mortgage for a house, but there are some important differences.
Okay, so I'm assuming it's not as simple as going to my local bank and asking for $1 million loan. What are the key differences between conventional loans for commercial properties and residential properties?
Commercial lenders focus on the property's potential to generate income, more so than your personal finances. They see the building itself as the primary borrower, not you.
Interesting. So even if I have great credit and lots of savings, if the property I'm buying doesn't have a solid history of income, I might have a hard time getting a loan.
That's exactly right. Lenders need to be confident that the property itself can repay the loan. They're looking for strong, positive cash flow, favorable lease terms, and a healthy occupancy rate.
Makes sense. It's all about the property's ability to generate income. Are down payments usually higher for commercial loans compared to residential mortgages?
They are. You might get a residential mortgage with 10% or 20% down, but commercial loans often require 20% to 30%, maybe even more. You need more skin in the game.
So higher down payments, and the focus is on the property's financials, not just my own. What else should we know about conventional loans?
It's important to really understand the loan's terms and conditions. Interest rates are key, but also points. Those are upfront fees and prepayment penalties, which apply if you pay the loan off early. It's not just about getting the lowest interest rate. You need to look at the total cost of the loan.
I need to read the fine print, not just focus on the big numbers.
Right. Now, conventional loans are often the first choice, but they're not the only option. Conti and Harris dedicate a whole chapter to creative financing techniques, ways to get access to properties, especially for investors who might not qualify for traditional loans.
This is interesting. Give me some examples of these creative financing methods. What are we talking about here?
One common technique is the master lease with option to buy. Basically, you lease the property with the option to purchase it at a set price later. It's like rent to own, but for a commercial property.
So you're controlling the property and potentially earning income from it while you're working towards owning it?
Yeah.
What other creative financing methods do Conti and Harris talk about?
They mention seller financing, where the owner becomes your lender. This can be a good option if you have a good relationship with the seller and can work out favorable terms.
That's interesting. You're cutting out the bank and dealing directly with the seller. Are there any other options?
They also highlight blanket mortgages, using the equity in a property you already own to secure a loan for a new investment. It's a way to leverage your existing assets. And they even touch on private funding, raising money from individual investors who are interested in your project.
So there's a whole world of financing options beyond just traditional bank loans. It seems like there's a lot to think about when choosing how to finance a commercial property.
You're right, there's no single right answer. The authors advise carefully considering your financial situation, your investment goals, and the specific property to determine the best financing method for you.
It's not just about finding the cheapest loan. It's about finding the right fit for your overall strategy.
Exactly. And just as important as securing financing is having a solid plan for managing the property once you own it.
That makes sense. But before we get into property management, let's take a break. We'll be right back to continue our deep dive into the world of commercial real estate investing. We're back and ready to tackle the hands-on part of commercial real estate, property management, the day-to-day stuff that keeps things running smoothly and hopefully making money.
That's it. Owning a commercial property isn't just about collecting rent. You're in charge of managing tenants, handling repairs, and dealing with all sorts of unexpected things.
It's like being a landlord, but on a much bigger scale with more moving parts.
Exactly. And Conti and Harris, they dedicate a big chunk of their book to property management. They lay out two main choices: managing the property yourself, the DIY route, or hiring a professional management company.
Ah, the classic DIY versus delegate dilemma. I'm always drawn to doing things myself, but I know I have my limits. What are the pros and cons of each approach when it comes to commercial real estate?
Well, with the DIY route, there's the potential to save money, no management fees, and you're in total control. You make all the calls, deal directly with tenants, handle every detail.
You're really hands-on with the property and everything that goes with it, but that sounds like a huge time commitment.
It can be. You're responsible for everything: tenant inquiries, repairs, rent collection, you name it. It's basically a second job, and it needs a particular skill set. You got to be comfortable with people, with finances, and with handling potentially stressful situations.
So DIY property management isn't for everyone. What about hiring a professional? What are the benefits there?
The main advantage is expertise. A good property manager brings a lot of knowledge and experience to the table. They understand tenant management, lease negotiations, property upkeep, all those things that can make or break your investment.
So you're essentially buying peace of mind, knowing that the property is being taken care of by someone who knows what they're doing. But I imagine that comes with a price tag.
It does. You'll pay management fees, usually a percentage of the rent you collect. So it's a trade-off. DIY saves money, hiring a pro saves time, and gives you expertise.
So how do you choose which way to go? Do the authors offer any guidance?
They recommend looking at several factors: the size and complexity of the property, how much time you have, and how comfortable you are with all the different aspects of property management. If you're busy and don't have a lot of experience, hiring a manager might be the smarter choice. But if you're starting small and you like being hands-on, DIY can be a great learning experience.
It's about finding what works for you, your situation. Now, regardless of whether you DIY or hire out, are there any general rules for effective property management?
There are. Conti and Harris emphasize clear communication. Establish open lines of communication with your tenants. Respond to their concerns promptly and keep them in the loop about important stuff.
Makes sense. Happy tenants are more likely to stay, which means steady income for you.
Right. Property maintenance is also critical. A well-maintained property attracts and keeps tenants. It also helps preserve the value of your investment. It's all about being proactive, dealing with problems before they turn into major headaches.
Stay on top of repairs, keep those common areas clean and safe, and basically make it a place where people want to live or work. Makes sense. What about the financial side of managing a property?
Financial management is crucial. Keep those records organized, track every penny coming in and going out, and make sure rent is collected on time. It might not be glamorous, but it's essential for a successful operation.
Okay, effective property management boils down to clear communication, taking care of the property, and sound financial practices.
Got it.
But what about protecting the property itself? Not just from normal wear and tear, but from legal and financial risks.
Good point. The authors have a whole chapter dedicated to asset protection, protecting your wealth from lawsuits or financial setbacks.
That sounds like something every investor should know about, no matter how much experience they have. What are some of the key strategies they recommend?
Setting up the right legal entity to own the property is super important. An LLC, a corporation, a limited partnership, these can shield your personal assets from any liabilities associated with the property. So if things go south, your personal finances are protected.
You're creating a barrier between you and the risks that come with owning a property.
That's it. They also emphasize getting proper insurance coverage. Property insurance, liability insurance, even legal defense coverage. You want layers of protection to reduce your financial exposure.
So you're not just hoping for the best, you're actively preparing for potential problems.
Right. And they even suggest looking into non-recourse loans. With these loans, your personal liability is limited, even if the loan goes into default. But beyond the legal and financial strategies, they also stress ethical business practices as a form of asset protection. Being fair to everyone, keeping your promises, and operating with integrity can go a long way in avoiding lawsuits and disputes.
It's not just about legal tricks. It's about building a reputation for being honest and fair. That makes a lot of sense. We've talked a lot about the good things about commercial real estate, but it's also important to acknowledge the potential downsides. Why do some commercial properties fail? What are the traps that investors should watch out for?
You're right. It's not always smooth sailing. The authors are very upfront about the risks. One of the most common mistakes is just making a bad deal to begin with, overpaying, underestimating costs, or not doing enough due diligence.
So it always comes back to doing your research. What are some other common mistakes?
Taking on too much debt can also be a problem. High mortgage payments can cause cash flow issues, especially if there are unexpected expenses or a drop in occupancy.
Seems like having a decent amount of cash on hand is really important in commercial real estate. What else can cause a property to fail?
Poor management is another big one. Whether you're doing it yourself or you've hired someone, ineffective tenant screening, not keeping up with maintenance, or poor financial oversight can all lead to trouble.
Finding a trustworthy property manager is key. Or, if you're going the DIY route, really dedicating yourself to learning the ropes and staying organized. Are there other things that can cause a property to fail?
Even the best managed properties can be affected by downturns in the market. A recession can impact vacancy rates, rental prices, and how much the property is worth.
Oh yes, the dreaded recession. But even if the economy takes a hit, aren't there things you can do to protect your investment?
Definitely. Conti and Harris recommend keeping some cash reserves to cover unexpected costs, diversifying your investments to spread the risk, and being proactive about adjusting rental rates or lease terms as the market changes. It's about being flexible and having a backup plan.
So even in tough times, it's not about panicking. It's about having a strategy to get through it.
That's the idea. Now, we've talked about the risks, but let's not forget that commercial real estate can be a very rewarding and profitable venture. And speaking of high rewards, we can't finish this deep dive without talking about land development. It's one of the most exciting aspects of commercial real estate.
Yes, land development. It seems like the ultimate way to create value. Taking raw land and turning it into something profitable.
It is. Conti and Harris have a whole chapter on land development outlining the potential profits, the challenges, and the strategies.
Okay, I'm all ears. What are the advantages of land development compared to just buying an existing property?
One of the biggest perks is the potential for huge profits. If you can successfully rezone a piece of land and develop it for a better use, you can significantly increase its value.
You're creating value where there wasn't any before.
Exactly. Another advantage is that you can often tackle large-scale projects with a relatively small initial investment.
Wait, how's that possible? Don't you need a ton of money to develop land?
Land development does need capital, but you can use money from investors to finance it.
You're essentially joining forces with other investors who believe in your plan. That makes sense. But land development also sounds really complicated. What are some of the challenges involved?
It's not easy. It's a multi-layered process, dealing with zoning regulations, getting approval from different government agencies, and sometimes even facing pushback from the community.
It sounds like you need to be comfortable with paperwork, bureaucracy, and potentially even some public opposition.
You got it. You need patience, persistence, and good communication skills to navigate the whole thing successfully.
Let's say you found a piece of land that looks promising. What are the first things you do?
The authors emphasize due diligence, just like with any other real estate investment. You need to confirm that the land is suitable for what you want to do with it, understand the zoning rules, and look into any environmental factors.
You're making sure there are no hidden issues that could derail your plans.
Exactly. Once you've checked the land's viability, you start talking to the relevant government agencies. This means submitting plans, getting permits, and going to public hearings to present your project and address any concerns from the community.
It sounds like a long and winding road. What happens after you've done all that?
Even before you start construction, you need a clear exit strategy. How are you going to make money from this investment? Will you sell the land to a builder, develop it yourself, and then lease or sell the properties? Having a solid exit strategy helps you make decisions and maximize your profits.
So you're not just developing for the sake of it, you're creating a valuable asset that you can either sell or lease to generate income.
That's right. Conti and Harris share some interesting case studies that show the potential of land development, even when things go off track.
I love hearing real-life examples. Tell me about one. What kind of challenges did their students face, and how did they deal with them?
One story that stands out is about a student who bought 12 acres to build a shopping center. But during due diligence, he found zoning issues that would have made the project way harder and more expensive.
That sounds like a major setback. What did he do?
He didn't give up. He changed his plan and decided to hold onto the land, hoping it would increase in value over time. He knew the area was growing, so he's betting on that. It was a gamble, but it paid off. Just a few months later, he got an offer to buy the land, and he made a profit of $500,000 just by holding onto the land.
That's amazing. Even when things don't go according to plan, there can still be a chance to make money if you can adapt and think long term. We've covered a lot in this deep dive, evaluating properties, financing, managing operations, even land development. Before we finish up, what are some key takeaways you want listeners to remember?
One big thing the authors stress is to get expert advice. You don't have to figure out commercial real estate all by yourself.
That's a great point. Having a team of people you trust, lawyers, accountants, brokers, property managers, can be invaluable.
You really can. Conti and Harris also emphasize the importance of continuous learning. Keep up with market trends, go to industry events, find mentors who can share their experience.
It's not a passive investment. You need to stay involved and keep expanding your knowledge.
Exactly. Real estate is always changing. The most successful investors are those who learn and adapt.
If our listeners were to walk away with just one key insight from this deep dive, what would you want it to be?
I think the most important message is this. Commercial real estate investing can be a really rewarding way to build wealth, but it's not a shortcut.
It's not about getting rich quickly. It's about planning carefully, making smart decisions, and putting in the effort.
Right. It requires due diligence, careful analysis, and a commitment to learning. But for those who are willing to take on the challenge, the potential rewards are huge.
Well said. Now, I'd like to shift gears a bit and hear your personal perspective on commercial real estate investing. What's the most important lesson you've learned from your own experience in this field?
The biggest lesson for me has been the importance of patience. Commercial real estate is not a get-rich-quick scheme. It takes time to find the right deals, to negotiate good terms, to build a successful portfolio.
It's a marathon, not a sprint.
Exactly. I've also learned how crucial it is to build strong relationships. Whether it's with brokers, sellers, tenants, or other investors, real estate is about people. Treating others with respect, building trust, and creating win-win situations are essential for long-term success.
Those are great points, and I think they really capture the wisdom that Conti and Harris share in their book. It's not just about numbers, it's about having the right mindset, the right team, and a vision for the future.
Absolutely. And for anyone thinking about getting into commercial real estate, I highly recommend checking out their book. It's a great resource for both newbies and seasoned investors.
I totally agree. It's been an eye-opening experience exploring this world with you today. Thanks for sharing your expertise and insights with our listeners.
The pleasure was all mine. And remember, this is just the start of your journey. There's always something new to learn and explore in the world of real estate.
So true. And to our listeners, I hope this deep dive has piqued your interest and maybe even sparked a passion for commercial real estate.
I hope so too. As we've learned, it's a field with so much potential for those who approach it with knowledge, strategy, and that entrepreneurial spirit.
I love that. One final thought for you. Conti and Harris emphasize that success in real estate isn't just about making money. It's about building something tangible, creating value for yourself and your community, and leaving a lasting legacy.
Now that's powerful. So go out there, explore your options, and think about how commercial real estate can help you achieve your goals, both financial and personal.
Thank you for joining us on this deep dive. Until next time, happy investing. That's a great perspective. It's not just about profits, it's about making a real difference. We've touched on some ways commercial real estate can go wrong, but what about those insider secrets for avoiding those pitfalls and really maximizing success? What are some of the less obvious things that even experienced investors might miss?
Well, one thing they really stress is knowing your local market inside and out. It's not enough to understand the general concepts. You need to know the specifics of your area, the people, the economy, the zoning rules.
So what works in one place might not work in another.
Exactly. Local knowledge is king. They also highlight the importance of having a strong team of professionals. Attorneys, accountants, brokers, contractors, people you can really trust and rely on for advice.
Yeah, that makes sense. Having that network of experts, especially when you're dealing with complex deals and high stakes, that could be crucial.
Absolutely. And they can't stress enough the need for a clear investment strategy right from the start. What are you trying to achieve? What kind of property are you looking for? How much risk are you comfortable with? Having a solid plan in place helps you make better decisions and avoid impulsive moves that could cost you money.
So you're not just jumping at any deal that looks good on the surface. You need to have a plan and stick with it.
Right. And last but not least, they encourage investors to be adaptable. The real estate market is always changing. What worked yesterday might not work tomorrow.
So be ready to adjust your strategy and stay ahead of the game.
Okay, that makes sense. Now, before we wrap things up, I'm curious about your personal take on all of this. What's the most valuable lesson you've learned from your own experience with commercial real estate?
I think the biggest lesson for me has been patience. Commercial real estate, it's not about getting rich quick. It takes time. Time to find the right deals, to negotiate, to build a portfolio.
It's a long-term game.
It is. And I've also learned how important it is to build genuine relationships, whether it's brokers, sellers, tenants, other investors. Real estate is about people, treating people right, building trust, creating those win-win situations. Those are crucial for long-term success.
That's great advice. I think that really sums up the wisdom Conti and Harris share in their book. It's more than just numbers. It's about having the right mindset, the right people around you, and that long-term vision. Couldn't agree more. And for anyone who's considering getting into commercial real estate, I definitely recommend checking out their book. It's full of great advice, whether you're just starting out or you've been doing this for a while.
It really is a fantastic resource. It's been a fascinating journey exploring this world with you today. Thanks for sharing your expertise and insights with our listeners.
My pleasure. I hope this has inspired some folks to explore what commercial real estate has to offer.
Me too. And remember, everyone, this is just the beginning. There's a whole lot more to learn and discover. So be curious, stay informed, and don't be afraid to take some calculated risks.
Well said. And thanks to all our listeners for joining us on this deep dive. We hope you've learned some valuable things that will help you on your own real estate investment journey.
Until next time, happy investing.